Jurrien, what is the market's expectations right now as far as potentially more fiscal relief?
The market is pricing in a V. I mean, there's really no way to get around that. Just a very handy way of looking at what the market is pricing in. Using this year's earnings, the PE went from 20 times at the high to 14 times at the low to 26 times now. On 2022 earnings, it's gone from 16 to 12 to 16. So the market is pricing in that the government is providing a full bridge to the other side of the abyss between monetary and fiscal. And obviously the monetary side is coming in loud and clear, and Chairman Powell has made that very clear as well in recent days. And now it's really a question of whether another fiscal is needed. And my guess is in order for that V to be correct, it probably will be needed. And then it's a question of what it looks like between the Democrats and the Republicans.
So you're saying the market is pricing in the fact that the stimulus that we've gotten so far will be enough to bridge the gap. And yet, restaurant executives in the White House yesterday were saying that they need to extend those PPP loans an extra several weeks to get through the reopening. So does the market have this wrong, Jurrien?
That is the big question, right? I mean, the market seems to be betting on the liquidity problem not becoming a solvency problem, and that's kind of been the big debate. And so I think the market is justified to be at kind of that mid-2000s level. We're higher than that at this point, but I think the markets are pricing in that by 2022, earnings are back to where they were in 2019. And, obviously we don't know the answer, but that seems to be what the market is pricing.
Eric, what will you be looking for from the Treasury Secretary and the Fed chief as far as potential relief and what could move the markets?
Sure. I think the biggest thing we're focused on is just the signal from the Fed. They've been very consistent and very clear with their message that they stand at the ready to do more as needed. And I think given some of the back and forth within the legislative branch right now, that the Fed will probably likely have to be that change agent as we wait and see what passes through the House and obviously the Senate. So bottom line for us is that we think that this is a very gradual transmission mechanism. We, as one of the country's largest lenders, are really involved with both the Main Street lending facility as well as the Paycheck Protection Program. And these things take time, both to process as well as to ultimately get to the many people who need them. So we do think that there is likely more to follow. The Fed certainly, again, has been very market reactive. We also think that ultimately there will be some more fiscal stimulus to come through the system just because that bridge that Jurrien mentioned has to extend further than where we are right now.
Hey, Jurrien, you had some good data over the weekend about the amount of money parked in money markets, dry powder, so to speak, nearing '08 levels. I wonder, can you talk about the sensitivity of that money to headlines like the kind we got yesterday out of Moderna? And what happens to that sensitivity if, in fact, we see the back end of rates start to climb higher?
Yeah, so my sense is just my gut feel is that, I don't know anyone who's bullish. so I think that the pain trade clearly has been higher. And when you look at, some of the investor sentiment surveys, the AAII has more bears now than at the bottom. There's $4.8 trillion sitting in money market funds. That's about 16-17% of market cap. It's not as big as '08, but it's certainly a large number, collecting nothing in interest and probably suffering from some FOMO at this point. And I think the rationale that most people have is that they're fearing that the other shoe will still drop, that states will reopen too quickly, and then you have a second wave. And then, like the news yesterday, when that comes out, I think it starts to make people a little bit more comfortable that maybe that second shoe does not have to drop. And there is a lot of money on the sidelines, no matter how you look at it. But again, when you look at the fundamentals, the market's pricing in 2022 back to normal. And the risk, of course, is that it takes longer. And that doesn't mean the market has to go down. It just means that the PE is going to rise even further for the time being while we wait for the earnings to come in. So there are a lot of different moving parts still.